YouTube. This is Mr. Ray, and coming to you this morning for the opening bell. I'm gonna take you into the opening bell. We're gonna talk about this volatility. We'll do a little geopolitical talk war, and maybe how it affects the markets. And we're gonna do all of that right after this buffer. Here we go. I got a little sitting here drinking my little morning water, a little ritual. You still got my little R for my name on here, and got some manuka honey, some cayenne pepper, and then I juice some key lime in the water. It's real good for you, man. Wake you up in the morning. You know, the cayenne pepper good for your circulation. You don't need any waking up this morning if you waking up looking at your portfolio. And so we're gonna look at right now. So currently I have 3 positions on in this particular account. We got I am losing water fast in the Australian futures. So the Aussie, which is kind of weird to me because it normally moves with gold, and gold is like killing it. If you didn't get a chance, check out the debate between Peter Schiff and Richard Hart yesterday. It was pretty good. I listened to it, and I agree with both guys on certain points. So maybe I'll talk about that a little later. I may do like a reaction video to that. I think I am going to do something like that, and I'll put that out later maybe. So right now, so let's start with the market, then I get over to the Aussie. It's a lot going on right now. You got the volatility. You got the VIX. The VIX is at 36 right now. So what's crazy about that, right? So that's volatility. Right, the VIX measures the volatility of the SPX, right, which is the options market of the S&P 500. So the VIX right now is at 36. I was listening to Tasty Trade this morning, and Tom Sosnoff had mentioned on there like the VIX, according to him and the research there, is only volatility has only been over 35 five times in the last 35 years. Like that's so if you play the lottery, look, volatility has only been over 35 five times in the last 35 years. So that's y'all numbers right there for the day. On the cash 3535, and then on the cash 43535. Right. All right. So we have very extreme volatility. What that means in the options market is basically measuring fear in the market. Options are going to cost more today, right? They're going to be more expensive. So that means that if you're going to pay up for this premium, if you're buying calls and puts, that means you're going to pay up, right? Insurance is high today. So you might want to sell them today if you're comfortable selling options, right? So what I got up right now is a chart of gold. These are the gold futures, and it is beasting right now. Like when you look at it, like this is gold futures. Like look at that. And one of the things about commodities, so like in the market, equities will crash down. So you have a stock market crash, you're looking at like the market crashing down, right? Commodities, stuff like these things crash up. Bonds, well, bonds can do both. Bonds can crash up or down, but generally with commodities, they crash up. And so now you're seeing, so it's crazy that they had that debate yesterday, and that was before, Bitcoin down, gold up. You are seeing what the hedge is for the market. Like the proof is in the pudding. I actually think that I agreed with both guys yesterday on certain points, right? But today, Peter Schiff ain't got to say nothing. He's showing you that when there's fear out here and the market starts crashing, that gold it reacts the way it does. So you can look at my screen over here on the side on my watch list, and you can see where the money is going today. The money is going into the bonds. The money is going. You got oil is up. You got gold is up, and Bitcoin is holding right around 35,000. Right. So we have to see if it's going to be able to continue to hold that level. You got the S&P futures are down 107 handles, and the market ain't even open. We about to get that bell in a minute, but this is going to be one of those markets to where you got to be comfortable with what's going with your risk, or you got to start making some adjustments. I think it's going to get. I think it has a propensity to get out of hand today. You'll probably see maybe some circuit breakers today. And I think the first. I think I'm not quite sure. Is it maybe 5% down or 7? It's one of between 5 and 7, somewhere around there. Well, basically, I'll call a halt to the market, let you collect your thoughts, and then slow everything down. You know, so I think we may get something like that. Maybe you may get a bounce today. Trading is going to be pretty fast. I think it's going to be furious. No pun intended, but I think you're gonna get a lot of action today at the bell. I do have. I'll probably be flat when this opens because I still don't understand why this futures position in the Australian dollar. Maybe it's just the overall risk of with the war, but because Australia normally the Australian dollar moves kind of in tandem with gold. It's kind of pegged to gold. And so that's one of the reasons why I got in this position was actually up yesterday. I was right here yesterday, right? It filled the gap, and then now you got this big red candle. And ain't no telling what it's gonna do, right? So the good thing about it is I bought a spread, so I can only lose what I paid for the spread, and I think I paid $240 for it. So the most I can lose is that $240. I still have 43 days on it, so I ain't really tripping on it. Anything can happen in those 43 days, I'll hold on to the position. It's just down $70 right now. All right, so that's cool. This SPY position is going to be in the money when the bell. Well, I mean, it was up yesterday when the market closed. It's gonna really be up when the market opens today. I think I collected 118. I don't know where it's gonna be at when the market opens. You'll see me. I'll probably take this off when the market opens. You'll see me close this out for a profit and take that money off of the table. So this will probably cancel out some of this. This AB V position is a put spread. It will open down about $3, which is what I need. This is what I want. I want AbbVie to go down. I like to see it because I have bearish delta. I have negative delta. So, well, actually, I do. I have bullish delta. Let's look and see. You can see. And I've been transparent with this with this account. You can see my option buying power. My P&L, excuse me, for the year is I'm up $195 in this account. And you can look over here, my deltas are +1. So actually I have a bullish portfolio here, which are really not bullish. And that's just because of the market is moving. So we'll see. This is going to change once the opening bell comes in. And I actually have some positive Vega, which is volatility. So we'll see. This is going to change when the market opens up. I promise you. And the market's going to be moving pretty fast. We got a minute to go for the opening bell. And I'm going to get ready to see we're going to see what happens when this thing opens up. And I may even put some more positions on. It just depends. I want to see how the tape looks when it opens up. So let's look at way over here. This is the S&P 500 futures right here. I want to make sure that everything looks the way I want it to. One of the things about it, I'm going to open up a little screen here, and there we go. Well, I can see the 1 minute over here in the corner. I got the 1 minute, and then you got the ES. And so let's go to the SPY. Let's see. Here's my position over there. I'll close this up. I hope the normally, so you see where it opens up as a gap. This is where, so this is how you get your gaps on your charts. Because just because the market was still you still had things going on in the market. And so yeah, you see how it opened gap down because the S&P 500 futures were already down over 100 handles. Here we go. Now, I want to take this trade off. You can see it's up 86 bucks out of the 118, right? I'm not going to hold this position. I want to take the profit out. So I'm going to close this position and take this money off the board. Let's see. I'm coming here. I'm going to buy it back. I sold it for 118. Let's buy it back. I'm going to set it for like maybe 31, right? Let's set it for 31 and see if I can get filled. So I collected 118, sold the open. I'm going to buy it back at a lower price. I'm working the order. Let's see if it come to me. I got it at 31. Let's go to 32. And let's see what happens. We'll let it work because the market is moving around pretty fast. It don't even have a mid price on here yet. That's how how the market is just moving. And you see it came up. Now we got 33 ticks. Do I want to give up 33 ticks? I mean, give up another tick to try to get this filled. We'll move it up. I want out. The reason why I want out because I may try to establish another position. Go ahead and take this profit off the board. Let's leave it at 33 cents and let's see what happens. See, that'll be in profit. This add V position because the market. So when the market first opens up, you're not gonna. It's gonna take a minute. Let's look at the tape. So we're gonna look right here, and you can see the expected move right now for this 35 day is about 45 bucks, right? And this little ruler in the middle, this is your expected move. So here, right here, and you see what this little like this is where the market is right here, 412. And this is where my call spread is. My call spread is way out here. It did not, when I put it on yesterday, it was right here. The market just went down and you can see it moving. You see this? This is the market moving and price being adjusted and vol and everything is bouncing around. So you actually watching like a live, what you would call a fast market. And this is a fast market. I have not been able to get filled yet. So I'm going to come up to 34 cents. I'm giving up. Every time you see me go up, I'm giving up a little bit of money because I want to get out. I want to take the profit off. I want to bag this. There we go. Right there. I paid up 35 cents for it. So all in all, it was 84 bucks I made on that trade. Right. And so, but now I got this one I got to deal with. I'm going to leave this one. I'm not really worried about the Aussie trade. I do think that we'll get a bounce at some point. More than likely, if the Aussie is down, let's go look at the dollar. Let's take a look at the dollar. So more than likely, if the Aussie futures are down, let's go take a look at the dollar and let's see what the dollar looks like. I'm coming over here, Tasty. This is Tasty Works. So I'm coming over here to futures, and then I'm going to go to the small exchange, right? And these are small products. So you have a small account, you can still trade futures and not have to put up as much margin on these particular products. That's why they're called a small exchange. So let's look at, you see right here, we got a gap up. This is the small dollar index. So it's running up, right? So with that happening, which is kind of weird, I wasn't expecting that, but we got the dollar up. And so that's why. And when you got the Australian dollar is pitted against the US dollar. So if we got the US dollar up, then thus we're going to have a lower Australian dollar. Now, looking at this, I would, if I had to make a bet at some point, I think that this gap will get filled, but that don't mean I won't take some pain in this position over here. I'm probably going to take a little pain, but I have enough time on my side to be right. So let's look at some other things that we got going on in the market, right? Like I said, we got bonds are up and they're rocking. You know, you got bonds up. This ain't a bad trade right here. So this is what I look for. I got a doji candle. We're gonna do a little technical analysis. When I have I just happen to look at this. I got a doji candle, which for me that signals like a bottom. That's something that I look for, right? I got a bottom, I got an up move, a little pullback, and then we got another up move here. So, but I don't like to trade the bond futures. So I would come in here. Let's look at the TLT. I like that. That's something that you know, looking at the bonds, this TLT, which is the ETF. You look up here, 20-year Treasury bond ETF. And you can look at like this level right here where it hit, where it touched, and you got a little up move. It's not a bad place to come in and place a trade, maybe. I'll come back to that and I'll watch this later on throughout the day. So let's look at FANG. I ain't in a hurry to throw anything on, right? We could take our time. You got a long day of trading. So basically, if we look at Facebook is down. Facebook been down, but you got a little bounce at the opening of the bell because the market gapped down so much. So Facebook down almost 2%. Apple's down. As Apple goes, the market will go. You know, this is that's why I do not think that this is the end of it. Like I don't think that this is the end of what's going to happen, right? I think that we'll continue to you may get some bounces in the market, but overall I do think that I don't think this is the end of this sell-off. I mean this market is, in my opinion, is still overbought. So you got Apple down 3.5% almost. Amazon is down. Excuse me. Google down. Google, I will today. I would think that Google will take out this low right here. So let's draw something right here. Let's put a level out. Before I would think about this is, see this gap right here. I like to look left, got a gap. Oh, brought up my fib levels when I did that. So yeah, this might not be a bad spot to get long. If I'm looking at this right, from here to here, and you can see I got a fib level right here, guys. So I could see Google, see how it's closing this gap. This is dangerous. So this is dangerous. You see Google closing this gap. Google go up, close this gap, but it didn't take out this low. Not yet. So Google go up, close this gap, and then you see it, then it turns and continues to go down, right? To take out this low and hit this level down here and fill this gap. So that's what we could be seeing right now. You see how Google opened down and it just wiped out all of this, and now it's up. So let's go back up. See how the futures equity. Let's go to the SPY. Like I can't talk today. So we got the SPY. You see how it opened down and you got a little green candle. It's like it's filling a little bit. What I'm anxious to see is to see if the sellers are gonna come in and hit this. Like, are they just, so right now, just like you see how I came in and I bought back my position, I covered my short. That's what you have going on in the market. People had down positions and they're coming in and covering their shorts. So you come in right now and you cover your short, and then it comes up and then you sell it. Like you cover your short here, then it pulls back and then you get short again. And that's how you have these big down moves. And so I do not see the end of like Tesla. Look at Tesla. Man, I'm telling you, this ain't it for Tesla. It came down here. This is a level that I have on another chart on Thinkorswim. I got a level like right down in here, and it came down and it touched it, right? Okay. So, you got a little bounce right here. It may come up, but I do not think that this is over. I just think it's just gonna it hit right here. You get a little move. You got shorts right now. They're covering the shorts. They're buying back. They're closing these short positions, which you have to buy to close, like I did. And once it gets back up in here a little bit, then they hit them again. And you may see another down move later on this evening, going into or even overnight, right? So let's talk about maybe you say, well, Ray, when I turn on CNBC, all I see them doing is talking about, you know, don't sell and hold on. What can you do? What are some of the things that you can do in a market like this? If you look, what's green on here? What's green on your screen? Like what's green? And I would advise everyone to set your watch list up like I have mine set up. I got vol, so I can see the volatility at the top. I got the VIX, and then I got VIX futures. I got the futures for the indices. I got the S&P, the Nasdaq, the Dow, the Russell. Then I got bonds and notes. I got oil futures, gold futures. I got Bitcoin futures, and I got the 10-year yield. And then right here underneath that, I got the XLF, which is the ETF of the financials. And then I got the ETF of the energy XLE. That's how I set mine up. And I can look at this tape. I don't even need to have this chart, to be honest with you. I can have it on the options screen right here, and I can look at the tape right here. And I can read this and tell you how the market's going, right? And then one more other thing that I like to have down here is the advanced decline. Out of 500 stocks, 447 of them are down right here. That's what this negative number is right here. So I know that I don't want to be long anything other than stuff that's moving inversely to the market. The things that are moving inversely to the market right now, you can see gold. This is the gold ETF. You got bonds. Now, also, I'm going to change this and we're going to go look at the futures. So let's pull up the futures. I'm going to come over here. I clicked over here where my name is, come to futures, and we're going to click on CME. I think CME is what? Chicago Mercantile Exchange. So we're looking at all of these you can trade on Tastyworks. And you see where the red is, right? Obviously, you would want to get away from the red. But if you wanted to get long, so we got oil futures, we got natural gas, we got gold, we got silver. Now look at these commodities and take a look at what's going on. So let's look at geopolitically how the war with Russia and Ukraine and how it affects markets globally. I'm not an expert in that, but I understand a little bit from what I understand. That part of the region is responsible for a lot of energy for Europe, right? Oil and natural gas. Thus, you see them up in the futures market. We got oil blasting right now. We got natural gas making a move right now. So so possibly what's a play here? You could get long futures, right? Put a stop here if you just want to get long naked futures, or you could sell puts or put spreads. That may not be a bad trade right here in that gas. Let's take a look at it. Let's see what that look like. I will come if I was gonna do it 32 days, and I just want to see what it will look like to do it. Let's say I sold the expected move. What delta? Come down here and look at let's see, the 16 delta, one standard deviation. I just want to see what it look like. So basically, you can get $100 for this. So you would sell if you sold this, you'd be selling the expected move. And if you wanted to do like I don't know, maybe an iron condor, eh, I wouldn't sell, I wouldn't, this could crash up. So I would probably come here. Let's say if you sold the 16 delta on each side, what happened? So that's not, collect 130 bucks, but max loss 370. You got a 66% probability of profit. That's not a bad trade. This is just a way. So like if you was like down and you wanted to find something like, what could I get long? Now, trading nat gas, if you didn't want to trade the futures in nat gas, I think UNG, let's look at UNG, right? Here is, and this is nat gas, I want to say, right? We got United States Natural Gas Fund. So you could come over here and maybe trade this instead if you wanted to stay in the stocks, or you could buy it. I don't think that it pays a dividend. Let's take a look. So there is no dividend associated with this. But if you just wanted to trade it, if you wanted to trade the stock and didn't want to do the future, I wouldn't go 22 days. I would come out 49 days. That don't mean you're going to hold it for 49 days. That just gives you more time. But coming in here, you're not getting a whole lot for it. You sell a put, you can collect $29. It ain't worth it. If you sold the 15 for 58, like, you're not getting much for trading this. Even if you did like a strangle, which I would be very, yeah, you're not collecting anything. So they're gonna, buying power is 475 to collect 91 bucks if you were to do a strangle. So if you're not familiar with that, that just means that if I were to do a strangle here, I would be short the 14 right here at 14, selling this 17 delta, getting short the 19, selling this 34 delta. I got a probability of profit of 68%, probability of getting 50% of this buck right here is 79%. So I got a 70. So if I sell it for 107, maybe try to buy it back for 54 cents, make $53 out of it. I got a 79% opportunity or probability of getting 50% of this. That's what that's saying. I would be cautious though. Like this will crash up. And depending on how this war goes, it could crash up. So let's go take a look back at let's look at the S&P futures. Let's just see how things are holding, right? We're still down about 2% right now. Like I said, I think we're gonna get, if you look up here, this is a 1 minute up here in the top right corner. You can see that we got a little bid, got a little up move going. I'm not looking to get long. I'm gonna be patient today, and I'll probably sit here and just watch the tape for a while. I generally in the mornings, I don't like to put trades on in the first 30 minutes. I like to sit and let the when the market open up, let everything play out. Let it go up some. I will be looking to sell rallies. I don't think this is over. We just getting into the thick of this. So be patient. Understand your risk today. Know be comfortable with what's going on. Like when you put something on, be comfortable with losing 100% of whatever you put on. If you do that, then you'll be fine. And you can see right here, I don't know, I've been down on this App V position, but as you can see, now it's starting to come back in for me because this is a put spread in App V. There was no, I have a way that I scan for certain plays on certain stocks, and this just popped up in my scan, and I just got shorted, right? No fundamental analysis or anything like that. Look, I got divergence up here. I seen a little divergence up here on the MACD. That's what this is, right? Whenever I see divergence on the MACD, you can see right here, boom, I got a high, momentum went higher, and then momentum dropped down. but price action continued to go up. So as momentum started to taper off, price action kept going up. So that was my divergence. And if you come down here and look at the RSI, you can see right here, I got divergence on the RSI breaking down. So for me, I want to be short that. One way of getting short is to buy so like you can buy puts. Like if you just came out here and bought this put right here, you pay 400 and you pay the mid price between 320. That's a wide it's a wide bid and ask. 320, 435. You're probably gonna that's a buck 15. You come in there, you're probably gonna pay like 380, 385, 390 for this put, right? Now, when you do that, you're gonna be susceptible to theta decay. But if you go out here and then sell a put against the one that you bought, you zero all that out. You zero out your theta, you zero out that. So right now, you're gonna be short and you're not gonna be susceptible to theta. So that's one of the things of buying the put spread, right? And it's cheaper. You don't make as much money if the market goes down, but you don't lose as much. So that's the thing, risk and reward are, related in that fashion. So I just came out and I bought. I think I paid, let's see, $91 for it. So I paid 91 for it, and I can make a buck 09. Right. So if I can get AbbVie to get this down move to keep going, I can get it down into here somewhere. One day it can do that. Just like this right here. So do you see this? If you had this put spread on like right here, you got what, 3 days? Boom. You made money. And that's all I'm trying to do is get a quick down move. So with that being said, you guys hit that like button, hit the subscribe button, share. If you guys like me doing commentary on the opening bell and giving you some little pointers, look at gold, man. The market's moving. When I started this video, it was up like right around like 47 handles. Now, if you look at it, you can tell gold. Look at that candle. Ooh, all of that, it just gave it up like that. So the market is really moving, which, if you're in gold, could be a buying opportunity. So you got it pushed down. If you think over the next day or so, it's gonna go back up and take that level out, you could get long gold, the futures, or you can come in here and you can get long. Let's see. Let's take a look at the GLD, this gold ETF, right? I don't know if you can see my levels, but I got levels on here. Let's see if they come on. You tripping. You gonna pop up? There we go. All right. Let's see if we can make these visible. These are my fib levels, right? I know I'm a big Fibonacci guy. This is how I can see what's going on, guys. Is that what? You can see it's a level right there. So you can see, boom, look. I got it right here. Hit right here. Got a pullback. Up right here, got a red candle. What next level? Look at it. So, and I got another level up there. So I don't think this is it for gold. However, we could get some down moves into here, right? On some of these pullbacks, and then maybe you can look to get long. Be careful. The market is moving very, very fast. We got the S&P futures are now only down 66 handles. When it opened up, I think it got down to like right around 100, right? So that's why I closed out that call spread, because if I hadn't have closed it out, then I wouldn't have made as much profit on it as I would have. So I closed that out immediately. You can even see that vol has come in. So this is a fast market. So be careful trying to trade something like this. The market, I think, is going to be moving like this for probably the foreseeable future. I don't think it's going to let up, right? Let's look at these. Let's look at volatility, the vol futures. Look at this. Let's look at the VIX. If we come look at the VIX, let's look at the option chain on the VIX. And so what I'm looking at IV, and I'm watching to see it's at 201 5-day, 172. These are high. 157. So it's going down the further we go out in time. So you can see volatility is tapering off, which is just letting you know that they're saying that risk is going down. So with that being said, kept you guys, I had to come on and do a video this morning. A lot going on. I'm gonna get off and then I can look at some other accounts and then look at some stuff and see if I can see what I can pull out the hat. And I'll probably be back later on, maybe later on today, and we're gonna talk a little bit more about that debate with Richard Hart and Peter Schiff. If you didn't get a chance to see it, look it up. It's on YouTube. It's pretty good. I think both guys make some good points, and I want to talk about that in a video on its own. And with that, happy trading, and I am out. Peace.